Hey everyone, welcome to CoveredCall ETF Investing, your central hub for deep CoveredCall ETF data. Today, we're going to be talking about three funds that have shown really impressive AUM growth, that is assets under management. We'll go through a little bit of their history from taxes and just performance data. And we're going to do that all, of course, as always, through the CoveredCall ETF AllStar tracker that you can pick up on my Patreon page or in the description or the first comment that you see below. So let's get into it. Okay, so let's explore three funds that have shown impressive AUM so far this year that this CoveredCall ETF AllStar tracker has been out. The first one came out in January and I update it every single month. So let's start with these three funds: ENCL, EQCL, and QQCL. The first one being the Horizons, well, it should say the what it should say is the Global X Canadian Oil and Gas Equity CoveredCall ETF. Then there is the Global X All Equity Asset Allocation CoveredCall ETF and the Global X NASDAQ 100 CoveredCall ETF. Global X was the parent company of Horizons. They just rebranded. It's all the same company, but they're no longer Horizons ETFs anymore. They're now Global X Canada. What makes these AUMs pop off? You're going to see a lot of green from these AUMs that are about to grow. We'll also go through some of the other tabs, like the data performance, distribution increases. We'll also look at taxes, maybe a little bit how their yields have changed over time. But the main reason why I picked these funds, not that they were the three highest growing AUMs, but I picked them out of a trend that I'm seeing so far this year, which is Global X as a fund manager seems to be dominating the Canadian landscape with AUM growth. Now for the September tracker that I release, I'm going to add in a column here that's basically the year-to-date growth. Now, I did have that in there for previous trackers, but there were just some issues with updating it. So I think I figured out a way to make it a little bit easier for those updates. So I'll make sure to include that once again in the September tracker. So if we start way back at the beginning of the year, we can see these funds had, two of them had single digits. One was about 35 million. I want to say they all basically started around the same time. Month over month, you can see January to February. ENCL rockets up 40%, QQCL 50%, EQCL up 40%. Great increases month over month. As we head into March, once again, more spectacular increases, 37%, 24%, and 9%. But you can see the trend of what's happening here. Amazing growth. These are becoming popular funds, especially from one fund manager, being Global X. This is the only dip we see from these three funds, which is EQCL going from 10.9 down to 9.6. A small decrease, but it does recover as we move into June with 17% to ENCL's 12 and QQCL's 21% growth. By this point in here, EQCL starts to take on much more growth as the fund is changing. It currently actually has QQCC in it. EQCL basically just invests in, it's basically a global fund. It invests in the S&P 500, the NASDAQ 100, the TSX 60 up here in Canada, and invests in developed markets and emerging markets indexes. But at this point in here from May to June, what you see is that EQCL boots out two funds, an emerging market fund and a developed market funds that did not have any CoveredCall coverage on it, and then replaced it with two funds that do have CoveredCall coverage over it. And then from June to July, once again, EQCL kind of staying within that range of 17%, 18%. ENCL slowing down a little bit at this point. QQCL still pretty healthy at 19%. I mean, all these jumps are really impressive. But now EQCL at this point is now starting to take the lead with that percentage growth. Maybe to many of you it's still a smaller fund, but I mean, as month over month, if we start to continue to see 18%, and once that's compounding, I mean, it's going to grow pretty rapidly, but that's basically what we see from these three funds, growing very quickly, impressive, and coming from a fund manager that I'm sure is no doubt loving to see all these AUM jumps. Now let's get into maybe the fund performances and maybe give us some clues as to maybe why that's happening. So ENCL, it invests in, I want to say it's 10 Canadian oil producers, and they're hand selected. It's not like those are off an index whatsoever, and they have a really impressive yield at 16.86%. QQCL, simply investing in the NASDAQ 100. These are all leverage funds, so for most of them, well, all of them actually, they all have another ETF that's basically a non-leverage version. So for ENCL, it's ENCC. For QQCL, it's QQCC. For EQCL, it's EQCC. So you get the idea. And so QQCL, at any rate, invests in the NASDAQ 100, the tech-heavy index. EQCL is simply just investing in a bunch of different indexes, which I explained over in the AUM tab, right? S&P 500, NASDAQ 100, the TSX 60, basically Canada's S&P 500, and the main emerging markets and the main developed markets indexes. So we get a few different yields here. Why is that? I mean, oil and tech, both very volatile, but the real key difference here is that tech basically pays out no dividend, whereas oil producers do typically pay out, right, 5-6% that they give back to investors. So naturally, you get lots of volatility, which is an environment that covered calls love to be in, because premiums go up. Cover calls, what they're worth, they go up. Plus, you're also extracting what these companies are producing, their quarterly dividends, and you get a high yield like this. EQCL, basically riding simply volatility without relying on high dividends to jack it up past energy. It just won't. I can't see a scenario where a tech fund, if it's on par with oil, that it's going to be past this. I'm sure that there are, and I don't want to talk about the single stock ETFs out there. Like, I know there's plenty of those that are higher, but they're just more aggressive. These ones are a lot more similarly built. So, but at any rate, that's why that one's a little bit higher. EQCL, the more you diversify across geography and indexes and industries, the lower the typical yield is going to be, but you're also buffered against, if some bad news catches that industry by surprise, you're going to have probably a solid buoy to hang on to in that regard. So let's move along to price performance, total return. All of these funds have been around for less than a year. Once it has been around for a year, these cells here, these boxes, get automatically populated. Some really tremendous year-to-date total returns. To my surprises, ENCL is beating out QQCL. Now, with our current economic cycle at play, here in August of 2024, the first week of August has seen the tech just plummet. And that's typically what happens with tech. It's rocket fuel in the good times. It's an anchor in the troubling times. Whereas, oil is just it is volatile, but maybe just a little bit more steady over the long haul. Right? Oil has basically traded at the same price, the average price for the last 20 years. So volatile, but maybe over the long run, it's been a little bit more stable, whereas tech, obviously, you see a lot more growth. You're not going to see the kind of growth in oil that you do with tech. That's just not a thing that's going to happen. Even the price performance year-to-dates are really spectacular. 11% year-to-date. These are all of the price performances of these CoveredCall ETFs, maybe with the exception of EQCL, are basically on par and if not beating the average S&P 500 yearly return. I want to say it's 8%, so EQCL on a price performance level is just below that, but still time to make up for that. So hopefully all these funds can beat historical averages as the S&P 500, as that is the typical benchmark of when people say, are you beating the market, referring to the S&P 500. So let's go along to the yield tracker. I like this because it tracks basically where the yields were at the end of each month. The ENCL yield has dropped about from 18.73% down to 17.25 as of August. Now we did just look at the yields. Now those, what we had just seen over here is live data. So this changes. Whereas over here, this is static. I'm just taking what it is on the last trading day of every month and populating it in here just to see what the yields look like over time. EQCL 11.48%, basically a marginal change there. Not much change in that regard. And then we got QQCL at 14.71%. down to 13.29%. And that, when yield is decreasing like that you can see from ENCL and QQCL, it's basically just because the price performance has increased pretty steadily. So that's what you're seeing there. If we go back over to the Canadian tab, one thing I forgot to show you all was information you would find on the fund manager websites. So things like management fees, 0.85, 0.75. And then the MERs actually just recently came out. So that's going to be an update for the September tracker update, which is updated MERs. So we can see that ENCL 2.24%, QQCL 2.33%, and EQCL at 2.49%. These MERs shouldn't be a shock. Most of it is eaten up by the leverage costs. The next big costs are the management fees, and then the other trading costs and marketing expenses that you might find in the MER, which is just a total of all of the fees to operate these funds. So we move along into distribution history, dividend streaks. All of them are at 9. If they can maintain their current distributions or grow it, then they'll maintain a distribution streak, all at 9 months. EQCL is the only one that's gone from, with a lifetime change of 7.69% from 19.5 to 21 cents. Now we should expect another jump for EQCL, in my opinion, a pretty big jump. Not really sure what the holdup is on it, but with replacing 2 funds that didn't have CoveredCall coverage on it, which eats up 40% of the fund, we should be seeing some growth. So I'm not sure what the holdup is on that, but maybe there's some precautionary reasons behind the scenes, especially with the newer funds that are inside EQCL, which are EMCC and EACC. Only been around for a couple months, so are they just wanting to see, are these funds actually going to stick around? I wonder if that kind of plays into it. New funds put in, will they have the popularity or at least enough of an AUM to justify being inside EQCL? Because if not, then maybe there's a chance that the other funds get put back into it, but then nothing changes. So I wonder if it's just a precautionary measure. That's a lot of speculation on my end for that, but I wonder if it has to do with the popularity of those other 2 new funds that got put inside of EQCL. But I think that's maybe a rational way of thinking about it. So only time will tell, but I'm happy with it at its current 11.5% yield. As we move into taxes, what we see from these funds is that taxes is broken down into things like return of capital, foreign tax withheld, foreign income, other income, capital gains, and eligible dividends. If you are not familiar with tax breakdown of ETFs, I got a bunch of videos on that, and have a playlist from April that really goes deep into taxes. I also have another section here that's just a mirror image. Instead of a dollar amount, I got a just a percentage breakdown. So with QQCL and EQCL, they're 100% return of capital, really tax efficient. That's not taxed at all. Whereas ENCL is, the vast majority of it is return of capital, but we also have a couple of spots with capital gains and eligible dividends. Again, very tax efficient in that way. In the end of things, hopefully you all enjoyed this video, and I will see you all in the next one.